So today we take a look at 10 important credit score myths that can end up hurting your credit and prevent you from increasing your credit score. Number 10. Having multiple credit cards hurts your credit score. False. The opposite is actually true, since the more credit you manage, the more credit track record you produce, and thus the better the algorithm can assess your handling of the allocated credit. This metric is calculated in the so-called utilization rate. Number 9. You need the perfect credit score to get the best deals. Again, false. The 850 score, which is held by only a very small group of people, might be a nice bragging right, however it is not required to qualify for the lowest interest rates offered by financial institutions, nor is it to qualify for loans. In most cases, if you have a credit score above 750, you will qualify for the best deals out there. Number 8. Pay a service to wipe away bad credit. It would sure be nice to take out a 50k loan, then straight to Vegas, blast all the money on hotel rooms, blackjack, and let's call it entertainment, while making sure to keep $100 left to pay this guy, let's call him Doug, the guy from Credit Swoosh, to give us a perfect 850. But this is not possible. There are of course some legit companies out there that can increase your credit score if there is some miscellaneous data in the system that is incorrect or no longer applicable. Like any other database, the credit score system gets corrupted and data entries sometimes get stuck or not processed properly. That is how this guy accidentally got labeled a terrorist, and how this Judy got merged with another Judy, adding a ton of debt to her credit score and lowering it significantly. But if you have actual outstanding debt or a bad payment history on a credit card or a mortgage, then this is simply part of your profile as a debtor and cannot be wiped away. It is the whole purpose of the credit card system to know exactly if and when you've paid your bills and keeping track of this for a long time. The only real way to fix this is to start paying all your bills on time over a long period of time while slightly increasing your credit every 6 months to a year. Before we continue, please like and subscribe to the channel for more finance and banking information. Number 7. Salary and income impacts your credit score. This one is also incorrect, even though it seems like a logical one, right? Now the reason why income does not impact your credit score is because it says nothing about your willingness or your punctuality in paying your credit card bills. In simple terms, just because you have the money coming in, it does not mean you are willing to use it to pay your bills or the outstanding loan balance on your account. The actual payments made in your payment history is much more important to the credit score algorithm than your salary or income. So why then the confusion about this? Well, this comes from the fact that when you apply for a loan or a mortgage, the underwriter will not base his or her decision solely on your credit score. They will take your salary and income into account, and at this point, your salary or income will definitely play a major role in their decision making. Number 6. Closing out accounts will boost your credit score. This is absolutely false and completely counterproductive, since the whole reason for having credit scores is to track a person's complete credit history. So the more data there is, the better this can be done. So assuming you pay all your bills on time and not let anything roll over, you will actually get a much higher credit score by having more credit cards and/or more credit allocated per card. Since the length of your payment history is a major factor in the credit score algorithm, having old, well-managed credit cards will greatly count in your favor and boost your credit score. Number 5. Only certain late payments will hurt your credit score. Again, not true. Every once in a while I hear a passerby advising this to their friend, that you can get away with certain late payments and that it will not affect your credit score. This is simply not true. All late payments will hurt your credit score. So why then do some believe this to be true? Well, it has to do with how different companies process your payments or lack thereof. Some companies are themselves slow to let you know that you've missed a payment or that the bill wasn't paid. And since the system is fully automated, it will get processed and sent to the general database to impact your credit score, even though you might not even be aware that you've missed a payment. Number 4. Checking your credit score lowers it. So the reason why this gets registered incorrectly with some people is because of mixing up the hard pull and the soft pull. When you check your credit score yourself, with for instance an app that some banks have on offer, this activates a soft pull, and soft pulls do not alter your credit score. The system merely registers them as an informal information request to check the data for informational purposes. Now when you do a hard pull, by for instance letting your mortgage advisor or a friend at the bank check your credit score, this will do a formal request for data verification. The system now thinks that you're about to request a credit line, and this could negatively impact your credit score, especially if this happens frequently. The new credit request is an actual metric in the credit score algorithm. So just always check your credit score yourself and protect your personal information so no one else can do this. Number 3. My credit score is 850, so I'm a baller, or rich for the non-millennials out there. Nope, you are not. You are still very basic. Having a good or even a very good credit score does not mean you are rich. It simply means the person has been managing their allocated credit very well for a long period of time. So, well done. Number 2, not using a credit card can boost your credit score. This is a golden oldie since many people still think that not borrowing or using a credit card is better. It is based on the belief that if you can just pay for everything that you buy in cash or upfront, you are more solvent and more fiscally responsible. While it is of course true that if you don't have any outstanding loans or need to borrow money for your purchases, that you are indeed very solvent, however, the credit score algorithm does not care about this. Its belief, if you will, is different from the human perspective. The credit score sees the credit as a responsibility. So the more credit you have, the more responsible you are, and thus the more trustworthy. So if I give you $5,000 and you are responsible with it, I can then give you $10,000 and so on and so on. This means that you have to actually use the money on your credit card for me to know that you are handling it correctly. So even if you just went to the bank, withdrew 70% of the credit you had, put it under your mattress for a whole month and then just bring it right back to the bank, this would be miles better than not using or having a credit card at all. Number 1, student loans don't affect my credit score. Unfortunately, some students still believe this and it's definitely not true. Yes, it is true for outside the US, where several countries do indeed separate the student debt from normal debt and they exclude it from the credit scores. In the US, however, this is not the case. And student debt is actually a special kind of debt that in itself has some major drawbacks compared to normal debt. But more on that in another video. These were the 10 credit score myths. Please like and subscribe to the channel for more finance and banking information. Take care.